You're looking in the wrong direction. Everyone's staring at housing, waiting for a crash like it's the only show in town, while the real danger is already tightening around the economy's throat. Credit is drying up in slow motion, one sector at a time, and most people won't notice until the ripple becomes a wave. Lenders are retreating, credit lines are shrinking, and approvals that were automatic 2 years ago are now getting denied without a second glance. Quietly, almost politely, America is entering the kind of credit contraction we haven't seen since 2008, and somehow almost nobody is talking about it. Let's jump in on what you need to know, but first, don't forget to hit like and subscribe for more U.S. real estate updates. Okay, let's get into it.
The crisis doesn't start when the layoffs hit the news. It doesn't start when the stock market falls or when economists finally step out of their bunkers and admit, yeah, things look rough. Recessions start long before any of that, quietly, invisibly, when credit begins to tighten. Because credit isn't just money, it's oxygen, and the entire economy is basically a giant organism that panics the second the air gets thin. The credit cycle is simple on paper and chaotic in real life. When times are good, lenders loosen up. Approvals get easier, standards drop, banks start acting like enthusiastic game show hosts. You get a loan, and you get a loan. Businesses expand, consumers spend, the machine hums. But when lenders get spooked, when delinquency rates nudge up, or when they smell instability in the distance, they slam the brakes, they pull back credit lines, they tighten lending standards, they stop saying yes. This is the part nobody sees because there are no headlines for silence. No charts go viral when banks quietly raise their credit score minimums. Yet this moment is exactly when a recession begins. Businesses go to refinance and discover their terms have doubled. Small companies that rely on revolving credit lines suddenly can't stock inventory. Startups that expect a bridge loan hit a bridge that's collapsing. Even healthy companies start operating defensively, cutting spending long before they cut jobs. When lenders pull back, the economy starts suffocating, slowly at first, then all at once. And by the time the public notices, the recession isn't beginning, it's already in motion.
If you think the credit system is humming along just fine, you're going to want to sit down for this, because the freeze has already begun, quietly, invisibly. And it's showing up in data points almost no one outside of financial circles pays attention to. Bank lending has been shrinking for the past 8 to 12 months. That's not a blip, that's a trend. When banks lend less, businesses can't borrow to grow, households can't access capital, and deals that once closed on a handshake and a good credit score suddenly die in paperwork. The pipeline of money that fuels economic activity is drying up. Small business loans tell an even darker story. Approval rates are plunging, down to levels we haven't seen since the early 2000s. These are the companies that hire locally, spend locally, and keep main streets alive. When lenders start turning them away, it's not just statistics, it's businesses that struggle to stay open, payrolls that get squeezed, and communities that feel the shock first. Consumers are signaling trouble too. Credit card charge-offs are spiking. People are using their cards just to make ends meet, and when those balances go bad, banks write them off as losses. That's what economists call final stage behavior, when borrowing stops being about growth and starts being about survival. Then there's the money supply. M2 is contracting. That almost never happens outside of serious economic tightening. When the overall money supply shrinks, it means there's literally less cash circulating in the system, less to spend, less to invest, less to lend. That's a textbook recession precursor. These aren't isolated anomalies. They're interconnected signals flashing red. While the headlines fixate on this or that sector, the bloodstream of the economy, credit, is already chilling. The freeze has begun, and it's spreading faster than most people realize.
Everyone keeps staring at the housing market like it's the main event, as if falling sales or rising inventory are the root cause of what's happening. But housing is never the cause. It's the first thing to crack because it's entirely dependent on credit. Mortgages don't exist without it. Buyers don't exist without it. And when lenders pull back, housing feels the blow long before the rest of the economy even realizes something is off. The moment banks tighten standards, the entire pipeline slows down. Buyers disappear, not dramatically, not with a crash, but with a quiet, stubborn refusal to qualify. People walk into a lender thinking, let's see what I can afford, and walk out realizing the answer is nothing the seller wants. And the sellers? They're always the last to understand the shift. They cling to last year's comps like they're sacred scripture, convinced demand will snap back any minute. Meanwhile, demand isn't just softening, it's evaporating. This time, the pressure is doubled. High rates already make mortgages painful. Layer strict lending standards on top of that, and you get a market where demand doesn't fall, it freezes. It's not that people don't want to buy, it's that the system won't let them. So those headlines about weak listings, slow sales, price cuts, they're not the disease, they're the smoke drifting up from the deeper fire burning underneath the economy. A credit contraction hits housing first because housing is the most sensitive instrument we have. And if this is what the symptoms look like, the underlying condition is far more serious than anyone wants to admit.
Corporate America is sprinting toward a wall, and the terrifying part is most people don't even see it coming. Between 2025 and 2027, roughly $5 to $6 trillion in corporate debt will mature. That means thousands of companies, big ones, small ones, publicly traded giants, mom-and-pop suppliers, will be forced to refinance debt that was originally taken out when money was basically free. Those days are gone. The same loans that cost 2 to 3% years ago are now resetting at 2 to 3 times that. Imagine running a business where your debt payments don't just rise, they explode. For companies with thin margins, this isn't a nuisance, it's a guillotine. This is where layoffs enter the picture, not because demand collapses, not because consumers stop buying, but because refinancing becomes so expensive that cost-cutting becomes the only lifeline. If you can't refinance profitably, you start trimming everything that isn't nailed down: hiring, expansion plans, benefits, and eventually people. And we're already seeing the trimmers. Earnings are softening. More CEOs are slipping challenging environment into their guidance calls. Profit warnings are becoming more common. Hiring freezes are spreading through industries that were aggressively expanding just 2 years ago. These are the early signs of a system bracing for impact. Corporate America is about to find out what happens when free money becomes expensive money. The era of zero-interest breathing room is over, replaced by a refinancing cliff that's waiting to claim the weakest companies first. And when that wave hits, it won't stay confined to the boardroom. It'll spill into jobs, wages, and the broader economy faster than anyone is prepared for.
The next pressure point isn't Wall Street. It's the banks sitting on Main Street, the ones most people drive past without a second thought. Regional banks don't make headlines unless something explodes, but they're the backbone of small business lending, local construction financing, and the day-to-day credit flow that actually keeps cities alive. And right now, these banks are getting squeezed harder than at any point since the run-up to the 2008 crisis. The problem starts with rising defaults. Commercial real estate is wobbling, especially office space that still hasn't recovered from the work-from-home reset. Small business loans are slipping too, as higher rates crush already thin margins. Regional banks hold a huge share of these loans. When they go bad, the banks feel the impact immediately, right on their balance sheets. And balance sheet stress leads to one thing: tightening, fast. Credit standards rise, approvals fall, and loans that would have sailed through 2 years ago now get rejected with a polite email and a shrug. We saw this exact pattern in early 2007, regional banks quietly tightening while everyone else was distracted by the strong economy. By the time people realized what was happening, the damage had already spread. The real danger is that when regional banks pull back, entire towns suffocate. Construction projects stall, local hiring freezes, small businesses can't roll over their credit lines, restaurants, contractors, family-owned shops, these don't survive long without lending support. This is the domino effect nobody is pricing in. When the regional banks squeeze, they don't just shrink their balance sheets, they starve the communities that depend on them, and that's where the recession becomes painfully real.
The most dangerous part of a credit contraction is what it exposes, and nowhere is that clearer than with the American consumer. On the surface, spending still looks strong. People are buying, traveling, upgrading, pretending everything is fine. But underneath, the pressure is unbearable. Credit card balances are at record highs. Delinquencies are accelerating faster than any time since the Great Recession. And the big squeeze is happening where the headlines aren't looking. Student loan payments are back, slamming millions of budgets that were barely holding together even without them. Auto repossessions are climbing because monthly payments have hit levels that would have seemed impossible 5 years ago. And homeowners? They're stuck. Mortgage rates are so high that refinancing, the usual safety valve when things get tight, is off the table for almost everyone. There's no relief valve, just pressure. This is the part of the cycle that feels strange in real time. People keep spending, but not because they're confident. They spend because they're trying to maintain the life they already had. It's a form of denial baked into the economy. And when credit tightens, that facade breaks instantly. Suddenly, the cards don't swipe, the loan doesn't get approved, the safety net disappears. The psychological shift happens quietly. People stop spending long before they stop working. They cut back, pull back, freeze up. That's when the slowdown spreads through every corner of the economy, from retail to travel to restaurants. The breaking point isn't ahead of us, it's already here, disguised as normal life, waiting for the moment the credit system pulls the plug.
While everyone watches Wall Street, an invisible crisis is spreading through city halls across the country. Municipalities rely on property taxes and sales taxes to keep the lights on, pay teachers, maintain infrastructure, and fund essential services. When credit tightens and businesses slow down, those revenue streams start to dry up. Fewer sales, stagnant property values, and shrinking business activity mean less money for cities to operate. It's quiet, but it's real, and it's growing. Some cities are already projecting major budget gaps for the next few years. Combine that with pension obligations that haven't been fully funded, and you get a fiscal squeeze that's almost impossible to escape. Officials can raise taxes, but higher taxes slow economic activity even further. Or they can cut spending, which reduces essential services, delays projects, and forces layoffs of city workers. Either choice accelerates the downturn locally, and these local slowdowns feed directly into the broader economy. The warning signs look eerily similar to what we saw before the municipal defaults of the early 2010s. Credit downgrades are rising, cash reserves are shrinking, and some smaller cities are already struggling to meet obligations without borrowing more. Once municipal finances tip, the effects cascade. Construction grinds to a halt, school systems feel the cutbacks, emergency services get strained, and local employment falls. Most people don't realize it, but the health of municipalities is a critical part of the recession puzzle. When cities tighten their belts, the impact isn't contained to one place. It spreads, quietly but aggressively, and it makes a downturn last longer and hit harder. This is one of the most overlooked cracks in the system, and it's already widening. The Federal Reserve is trapped, and this time there isn't an easy escape. Inflation is still stubbornly above target, which means cutting rates to stimulate the economy could spark price surges that no one is ready to handle. But raising rates further would accelerate the credit collapse that's already underway, making borrowing even more expensive for businesses and households. The Fed can't do both, and trying to do either comes with massive consequences. In previous recessions, the Fed could respond quickly.
A cut here, a liquidity injection there, and markets stabilized. This time, those tools are limited. The credit system is already stretched thin. Banks are tightening, borrowers are over-leveraged, and debt levels are near record highs. Injecting liquidity won't magically create demand. It only temporarily keeps the system afloat. You can flood the banks with money, but if businesses and consumers can't borrow or spend, it doesn't solve the underlying problem. The scale of this challenge is unlike 2008, 2001, or 1990. Back then, the Fed had room to maneuver. This cycle combines stubborn inflation, high interest rates, historically leveraged corporate and consumer debt, and a credit system that is already cracking. It's a perfect storm of policy constraints and economic pressure. Liquidity tools might calm markets briefly, but they don't prevent layoffs, defaults, or the cascading effects of a contraction already underway. The Fed can slow the damage, maybe by a few months, but they can't prevent it entirely. This isn't a small correction. This is a multi-layered credit crisis, one that exposes the limitations of central banking in a highly leveraged, debt-dependent economy. And that's why the next downturn could be deeper, longer, and more unpredictable than almost anyone expects.
Everything we've been talking about converges in a single, predictable pattern. It starts quietly, almost invisibly, with lenders pulling back. Lines of credit shrink, loans are denied, and approvals that once seemed automatic suddenly disappear. The economy doesn't make headlines when this happens, but the effects ripple through every sector. Once credit tightens, spending drops. Consumers already maxed out cut back. Small businesses postpone purchases. Large corporations halt expansions. Cash flow slows, and the velocity of money, the lifeblood of the economy, begins to falter. You don't see it immediately, but it's happening, one quiet transaction at a time. Then revenues start falling for businesses across the board. Retail, manufacturing, construction, even tech. The decline spreads because fewer dollars are circulating, and every sector is interconnected. Profit margins shrink, balance sheets tighten, and companies start making the painful choices that follow. Layoffs accelerate. Initially, it's a trickle, temporary positions cut, hiring freezes announced. Then the trickle becomes a flood. Payrolls shrink, consumer confidence falls further, and the cycle feeds on itself. Each lost paycheck becomes a lost sale, and each lost sale becomes another cut somewhere else. Finally, the recession becomes official. Economists confirm what everyone already feels in their daily lives, but by then the damage is already done. This is the slow part. The fast part comes next, the cascading, accelerating effects that turn an invisible credit freeze into a full-blown economic collapse that hits everywhere all at once. The signs were there all along. Now the consequences are unavoidable. What comes next is already visible in the numbers, and it isn't subtle. Over the next 6 to 18 months, layoffs will spread across industries, starting quietly in 2025 and accelerating into 2026. Construction crews, retail staff, hospitality workers, and employees in lending and financial services will feel the first wave, followed by more widespread corporate cuts as balance sheets tighten. Corporate bankruptcies will rise as companies that borrowed heavily at low rates struggle to refinance debt that has now doubled or tripled in cost. Housing activity will slow further as frozen demand meets sellers still clinging to pre-crisis expectations. Regional banks will respond by consolidating and cutting back lending even more, amplifying the credit squeeze that has already started. Markets will respond with sudden spikes in volatility as investors finally price in the real risks, and stock valuations, particularly for highly leveraged companies, will reprice quickly. Every shift in lending, spending, and business profitability feeds into this feedback loop. As consumer spending slows, retail sales flatten, and businesses pull back, the recession will stop being invisible.
It will declare itself in job losses, shrinking economic activity, and headline-grabbing corporate struggles. By mapping this timeline, you can see how the crisis is likely to unfold step by step. It's not instantaneous, but it is inevitable. Understanding this sequence gives a rare edge. While others react to headlines, you can anticipate the economic dominoes before they fall. Recessions destroy, but they also create opportunity, especially for those who see it coming. As credit tightens and weaker companies falter, competition thins. Businesses that survive face less crowded markets, lower valuations, and a chance to capture market share that would have been impossible during boom times. Labor markets shift in interesting ways, too. Employers who are prepared can hire skilled workers at a fraction of the cost from just a year ago. Teams can be built stronger, faster, and smarter, while others are scrambling to hold on to staff. When debt resets, the companies with solid balance sheets emerge leaner, more efficient, and ready to dominate. Cash reserves suddenly become a competitive weapon, allowing strategic acquisitions, investment in technology, and expansion while rivals struggle. For investors, opportunities multiply. Assets that were inflated by easy credit drop to levels that make sense. Buying while others panic isn't reckless, it's disciplined. History shows that every credit contraction rewrites the landscape, determining which companies, investors, and entrepreneurs control the next decade. This is the flip side of the cycle. While the economy tightens and headlines scream crisis, those who prepare can turn what looks like chaos into their greatest advantage. The trick is recognizing the signals early, understanding the timeline, and acting decisively. This isn't just survival, it's positioning for the rebound that follows.
This credit crisis is the hidden trigger behind the next recession, and almost no one is paying attention. If you want to see how it unfolds, who will be hit first, and how to position yourself, hit subscribe and let us know if we hit the mark in the comments.